Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week on the podcast, I'm delighted to have two of my regular guests to talk about the events of the week, not just in the markets, but also what I suspect we can call the great Saba saga that has been unfolding, the drama that's been unfolding this week, when we heard from Bose Weinstein, who is the founder and CEO of Saba Capital, when he recorded a webinar, more than an hour and a quarter it lasted, in which he effectively laid into the UK investment trust industry. I think that's fair to say. He was very vocal in his criticisms of boards, fund managers, and even the media as well. I mean, how could he possibly think of doing that? Anyway, to discuss all this, I'm joined by Andrew McHattie, the editor of the monthly Investment Trust newsletter, and by Ewan Lovett-Turner, who is the head of investment trust research at Deutsche Numis, one of the leading brokers in the investment trust sector. I think we do need to start off with the Saba drama. It was a quite extraordinary webinar, I thought, unlike almost any that I can recall over the years. I wonder first, Andrew, what you made of it. What's your reaction to the style and the manner of the webinar before we talk about some of the issues that he's raised and everyone in the industry has been talking about for the last few weeks?
Well, we're used to very carefully scripted events and webinars, and certainly when you're hearing from fund managers, very often they're speaking very much to a script and making sure that they're on message. Whereas this actually was a very different kind of presentation and seemed to be very much from the heart, actually, and was highly emotive, really quite aggressive in tone, and very much off the cuff. He was expounding, of course, a very firm view that he has in this extremely divisive debate. And I think he was inevitably pushing his side of the argument, which is very clear and crisp. And I think it's understandable that that was what he was doing. But it wasn't necessarily very well reasoned. And I'm sure, of course, the entire investment trust industry can push back on most of those points. But I think what it demonstrates is just actually how emotive this whole issue is. Because, of course, for those in the investment trust sector, it's actually an existential issue to some degree, whereas actually for Mr. Weinstein, it's very much his agenda. This is what he's been spending his time on. And so, yes, he was backing that up with some quite strong rhetoric.
He was certainly strong on the rhetoric, as you say, and the language was quite dramatic in some places. He talked about the ecosystem of the investment trust industry, and he lambasted most of the members in it. What did you make of the style of it, Ewan?
Yeah, he's definitely got his own way of doing things, which, as Andrew said, is very different from what we're used to traditionally seeing. And part of his argument is to make things pretty emotive and a case for change. And he's come across a sector and timed things pretty well, seen value when lots of people have been deserting the sector. Often, yes, definitely on investment grounds in some cases, disappointing performance. In some of the cases, that's very hard to argue against. But also when traditional buyers have been disappearing, wealth managers focused on liquidity, cost disclosures putting people off, even potential capital tax changes leading people to sell. And he's capitalized on that to take big stakes. And therefore, he does have a pretty big say in the future whether these proposals succeed or don't. So it's going to be a very interesting one, how this plays out. And whatever happens, I think this is probably round one, and we've got a number to go through before the bout is over.
Yes, well, let's just remind listeners what Saba has actually done. It's built up significant stakes in nearly 20, I think, trusts overall, at least have been disclosed. And he's picked on these 7 just before Christmas to requisition meetings at which he's proposing a resolution that would see the entire boards of these 7 trusts removed. And then he was also putting forward a second resolution that would see Saba representatives put on the board of all of these 7 trusts and a second director nominated by them, producing a board of just 2, and after which he's saying he will provide liquidity opportunities and potentially start, if you like, an activist discount chasing trust that will target other trusts in the UK sector. That's his plan, and he would then manage that himself. So what we can say about it, well, let's start with some of the issues he raised, looking behind the rhetoric for the moment. I mean, the first point he made was that in the case of these 7 trusts, it has been his buying that has effectively narrowed the discounts on those 7 trusts. We can't really disagree with that. That is a fact. I think that's an observable fact if you compare to how discounts generally have moved and the trusts that he's targeted. Would you think that's fair, Ewan?
Yeah, I think that probably is. And that's the big tipping point now, and risk for the trust is potential widening of those discounts if nothing happens after these votes. And that's one area slightly surprised by some of the boards not coming out with more proposals of perhaps a sweetener for investors if they stay invested and back the existing board and management team, of what you'll see in future to try and keep discounts tight. And we have seen from some of that cohort returns of capital, even funds proposing to wind down after difficult periods. So there are degrees of that to some of the funds, but in others less so. And I can understand that, in that these proposals have come over Christmas and there's a limited time period, and actually let's just focus on the single key issue, I suppose, which the big one that dominates is the governance concerns and where that leaves investors in terms of governance, as well as what the future holds. So I think there's probably more to come from boards about that future and that potential managing of discount in future, but that focus on governance and where that leads you, and the uncertainty and lack of clarity in the proposals is really been the key area that boards have been focusing on to pitch this battle.
So I think, Andrew, do you think it's fair to say that by doing it this particular way, by doing 7 at the same time, and also proposing something which is clearly not in the spirit or indeed the letter of the corporate governance standards that are widely accepted over here, he may have given boards an easier defence to mount, if you like it that way, by doing something which is clearly against the spirit of the corporate governance code over here, and indeed might even, in one respect, fall foul of the listing rules. Would that be a fair comment?
He hasn't broken any rules, of course, and he's just been very clever, actually, in the way he's done this and with the timing. And we might not like that, but actually it's quite a smart move on his part. But I think there are things he could have done much better. One of those is actually making it much clearer exactly what his proposition is, because we don't really know very much about what his future trust might look like if he does succeed in taking over the mandates here. We don't know what his charges will be. We don't know exactly what the policies will be. It's very different from a trust trying to raise new money at IPO, where you get a very detailed prospectus that gives you masses of detail. We just don't have that here. So I think that's one grey area. And certainly another one is actually exactly how the boards are going to respond, because if these proposals are voted down, then we don't know what happens next. We don't know if Saba is going to try some different resolutions, or whether it's going to try and sell out, whether it's going to push for a cash exit. I mean, I'm presuming it will want its money out again. And so these boards are going to have to think about perhaps some kind of tender offers or some kind of maneuver to make sure that the discounts don't just flush right out again and go back into double digits. So I think, as you rightly said, this is round 1. There's quite a lot more fighting to come.
Yes, I think that's right. I guess what you hear from the boards, or what I've heard from the boards of those trusts I've spoken to, is that they've had dialogue with Saba, and they were all very gentlemanly at first and all the rest of it. And then suddenly they had another flurry of buying just before they announced this campaign, if you like, these votes. So the boards say they were taken a bit by surprise by this, because they had conversations before. And I think many people just thought they were looking for a classic sort of activist play where they would build up a big stake, they'd go to the board and say, do something, and that would probably include a return of capital or some kind of way in which they could realize their investment, and they would effectively make some money by doing that. But they've kind of moved it on, haven't they, to another level by proposing themselves as potentially the managers of these trusts. Did those tactics surprise you, Ewan?
Yes, no, I think definitely, yes, it's very unusual to see them all come together, 7 requisitions at the same time, and they're looking to take over the management contract. I suppose we shouldn't be surprised that there's a record of Saba doing that in the US. It has been a tactic commonly used by some activists in the past. It does make it a lot more attractive for them in terms of getting that longer term income stream, and potentially rolling that up over time is their plan. So, that motive's become very clear. And I think where perhaps some of the value of the argument that he's working for all the small retail shareholders is slightly worn away when some of these companies have existing or now current proposals to whether it's wind up or significant returns of capital. And it's quite hard to argue in the face of that they'd be the best targets for this sort of thing, unless you're actually just after the management contract and the fees that brings your business. So perhaps a smaller list, more targeted, would have been stronger for his case. And the key point, again, you mentioned the letter and spirit of governance rules and the like around that independent board. And the value of the sometimes much maligned independent board of investment trusts is, I do think that does have huge value. In the good times, you don't really notice, but in the tricky times, hopefully that comes to pass. And here you've got the appointment of one representative from a large shareholder, not currently the manager or not strictly the proposed manager, given the ambiguity of the rules. Clearly not independent, and Saba won't consider that person independent. But the director that they're proposing, I understand, will be considered independent. The second director, given as long as they don't have significant business relationships with that large shareholder. And that's where you get the spirit and the letter of the law. And I think there's a natural ambiguity and vagueness to the proposals, so they don't fall under the sort of trying to explicitly take control of the company. And therefore you end up in takeover panel rules and all sorts of different areas, which would make this a lot harder to achieve. So it is riding that, close to the wind, or many people would say, well, beyond it. But definitely the spirit of things, you'd be effectively, in my view, handing control over, and they've set out what they want to do and roll that up and change the strategy of these funds. And shareholders need to be very comfortable that they would be happy with that, and they would be happy giving away that governance and control, which I don't think shareholders should do that. I think maintaining an independent board who can decide whoever they want to appoint is hugely valuable and worth keeping. That may lead to slower change than people want generally, but it does mean that it's sort of reasoned and thought through and due process is followed.
Yes, I mean, it's fair to say that he has pitched himself as the voice of the mom and pop investor. But I guess one issue here, Andrew, is that, as has been, I think, now quite widely discussed, the boards have got to get the vote out. If they want to win these votes, they've got to get the retail investors to vote. Typically on these trusts, there's some 30-40% of shareholders are retail investors who hold their shares through platforms where voting is rare and often seen to be quite difficult to get people to vote. But, I mean, if nothing else, this campaign has prompted the industry, the AIC, and many of the fund management firms to get in contact with the platforms and try and get them to do more to help retail investors to vote. But do you think this has highlighted effectively what is a structural issue for the investment trust sector, the fact that retail investors mostly own their shares through platforms and mostly don't vote?
This is a massive point, I think. And of all of the many ramifications that follow, I think, from this episode, this could be the one that actually is the most important of all. Because, of course, retail investors are a very important buyer of investment trusts, which has been seeking this additional marginal buyer, and retail investors have stepped in to some degree, and they're increasingly important to the industry. But they do tend to own shares now through these big platforms, which effectively block the direct route of communication between investment trusts and their shareholders, because the shares are held in nominee names. So the voting is not straightforward. And I think actually historically, retail investors have not tended to bother very much in casting their votes. And that actually is partly, as Ewan was saying, because they've trusted the boards and the governance process. So if you do trust the board, then often you don't need to vote, because actually you're very happy with the governance and you're happy that actually everything is being done correctly and your vote is not tremendously important. Now, I think that's changed very much with this, and it's put the spotlight on the need to vote and the need to know that you can vote. And often, actually, the platforms don't tell you about votes, and you've had to opt in to get notifications. And I think that may well change. There's a bit of an FCA spotlight on this now, and the responsibility of the platforms to make sure they're communicating rather better with retail investors, and to make sure that actually the votes count. And of course, we've talked as well about the important year coming up with a lot of continuation votes. And once again, I think it's untrue to think that your vote is unimportant. And actually, it does matter that you get out and vote, not just on these Saba resolutions, but actually on these future continuation votes. And in my mind, it's very much a responsibility of the platforms to make sure they're communicating rather better with retail investors.
Yes, I think that's fair. And Ewan, I think it's certainly been a wake-up call for a number of investment trusts that this has highlighted this particular problem. One of the oddities was that I think this ordinary resolution was not deemed by some of the platforms to be a corporate action, and therefore, even by their own policies, did not have to notify retail investors of it. I think that's changed now. So do you think this is going to be a lasting impact, as Andrew suggests, that the boards are going to have to do much more to stay in touch with their private investors, which they say they value highly now?
Yeah, I think definitely a lot of this dates back probably 15 years or so when management groups owned share schemes. People used to invest directly through these share schemes into the trust themselves. And you had that direct link, but they were passed on to the large retail platforms for sort of ease of administration on both sides of the equation, really, the retail investor and the management groups. And that is a massive sticking point, that ability to communicate directly with your shareholders. Some management groups have done very well of trying to rebuild those lists through now that you're signing up for your webinars or your interesting marketing pieces or thought pieces that go out from some of the management groups, and getting that connection again is really key going forward, because the options are limited in terms of directly contacting shareholders. So I think that's important, and sort of echo a lot of Andrew's views on what might need to happen about voting. But the turnout in this specific instance is going to be key, because the size of some of those stakes, you do need to get a lot of shareholders out and voting. And when you're facing 20, 25 or up to 28, 29% stakes, you've got to get a lot of the rest of the register out to vote that down. So that turnout will be key. And that means that even with a lot of press coverage, a lot of pretty vehement views from the boards coming out in documents, it's still going to be tough, and it's going to be interesting to see to what degree he might be successful in some. And I think that targeting of retail-dominated shareholder registers has been a key part of the tactic, and maybe fingers were slightly burned in European opportunities, which a high retail element, but also some institutional investors in there who didn't necessarily go along with all of the Saba plans, I think now on a year ago, when it tried to force returns of capital with that vehicle. So, that's been a particular tactic, and certainly one we need to make sure that decisions are made in the interest of all shareholders, not just the loud few.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. I'm going to ask you, Andrew, in a moment, hazard a guess as to what will the outcome of the votes be. But before that, I just wanted to ask this question, which is, there are activist investors, or at least that what we call discount players in the UK investment trust world. People mention names like City of London and 1607. And of course, we have asset value investors as well, who operate in terms of trying to play discounts. But in terms of activism, it seems to be a question which no one has addressed, actually, is whether or not there is a place for, it doesn't have to be run by Saba, but for a kind of listed discount activist fund that could go around and put pressure on investment trusts whose boards are perhaps being rather complacent. Do you think there's actually a market for that? Whether or not you would like Mr. Weinstein to be running it, do you think there's a market for that?
Well, if you're a really cheeky devil's advocate, you can say that the industry's been looking for a marginal buyer of investment trusts for quite some time, and perhaps a very large vulture fund is the way forward. That is a marginal buyer. And actually, Saba has put a lot of capital into this sector and succeeded in narrowing discounts as a result. So That is one argument. And of course, this isn't new. I remember in the 1990s, there were vulture funds, as they were called at the time. There was Advanced UK and Advanced Developing Markets that were set up, established as listed investment trusts to do this exact thing, to buy trusts on wide discounts and come out at narrower discounts. So this isn't a new thing. We've seen it periodically in the past. And I think they can serve a useful role. It's good to have any buyers of investment trusts around, whether or not you like their tactics or not. And I think in this case, Saba perhaps is not the one we would choose, but there could be a place for that kind of fund, not necessarily as a result of these votes, but perhaps from somewhere else.
Yes, it was interesting that he referenced the situation of hypnosis, for example, in his webinar. That was an example where activist shareholders did force a better outcome, if you like, than was previously on the table from a complicated situation. So do you think there's a case for that kind of fund, Ewan?
Ultimately, yeah, there are a couple where you've got things like AVI Global and MyGo, a bit of a smaller one, but who do look to take engaged approach with investment companies and in some cases holding companies to affect change, but a lot less aggressive than this. I certainly think that there probably is, and whether Saba could potentially make a decent fist of it, I'm sure they've been pretty canny in identifying value ultimately. So it could be interesting in time. I think, difficulty is here is, I think they could have made a stronger case for themselves by, I don't know, probably understanding the softer attitudes to governance and unlocking value, and sort of not leaving the field that it's just not cricket the way that this approach has been done, and that slightly undermines your positioning and probably backing in the market.
Yes, it's funny that in his interview about a year ago, he talked about what he liked about the UK market was the fact that we all play by Queensberry rules, But it doesn't seem that he's necessarily going to apply those rules to himself. And I also want to talk about Herald. I mean, Herald is an interesting one because it seems that he's sort of miscalculated. He perhaps failed to appreciate quite how highly regarded Katie Potts, who's the manager and sort of founder of Herald, has been. And he's had to change his proposals in that case because he talked about the special love that the market seems to have for Katie Potts. I mean, Herald is a slightly different case because of the nature of what it does and the fact how long it's been doing it. And you can argue about its track record, but long term has been very good. Do you think that has been a miscalculation on his part, Ewan?
Well, you've had a couple of institutional sort of wealth managers come out, or investors saying that they're going to vote against, which is quite interesting, setting the tone on that. And it does raise that big question about performance. Monitoring performance is very difficult, and people's time periods, and really Saba's been pretty canny at picking the 3-year period that, while both markets and particularly investment trust markets had a pretty difficult time from the change in interest rate environment at the back end of 2021, 22, and that really has made recent periods for growth investors, some of the small caps that you see in a number of these portfolios struggling, and things like technology. So picking that particular period, understandably, these come in under pressure. And it's right at this moment to be asking questions about the performance and whether you continue to back it through the next cycle. But I think in the webinar, he extended his time horizon to perhaps 4 years for one of the trusts. I think for investors, investment companies, their time horizon is typically a lot longer. You still need to hold account over shorter time periods. But Katie Potts' record over the very long term remains impressive despite tougher times more lately, and that has brought her a lot of credibility with investors who've owned it for a very, very long time. So it raises that point on what your time horizon is in terms of generating that value. And that difficult few-year period has led to a number of the trusts reassessing what they do and ultimately their existence. So that's sort of fair enough to scrutinize those, but others are making tweaks and changes to approach, lessons learned, and changing things on. But certainly for some of those long-standing managers, there's a lot of currency built up with long-standing investors.
So the Herald vote is the first one. They brought that forward, I think, to the shortest period of time. What are your thoughts on Herald, Andrew? And I am going to ask you, do you think he's going to win any of these votes? And if so, which ones do you think are the most likely to get the Saba treatment and by the vote passing?
Well, let's talk about Herald first. And it is very timely because today, the day we're recording this, is the deadline on platforms to vote on that one, actually. And I know that because I have voted, because I'm a long-term holder of Herald. And I think the point that Ewan has just made about time horizons is really important, because actually, if you're a private investor holding an investment trust for the long term, your horizon's really not 3 or 4 years. I mean, it maybe is a 10-year, 15-year time horizon. And I've held Herald for a very long term, and I'm very satisfied with the returns. I also like the fact that Katie Potts is a big supporter of the small UK tech industry. So, there are softer factors at play here as well. So it won't be a surprise I've cast my vote against the Saba resolution there. But I think it's going to be very interesting to see the result. I actually don't think he is going to win any of these votes, because I think it's actually been quite an impressive mobilization of the media and the sector as a whole. We've heard from absolutely everyone in the sector. I think, every commentator, every analyst, everyone I know in the sector has had their word on this and made it clear that everyone should get out and cast their vote. So I'm hoping there'll be a good turnout. And I think if there is a good turnout, then these propositions will probably be defeated. But it's not just the black and white result that counts here. It's the quantum involved. And I think if any of these votes are quite narrow in terms of the result, then that may well give Saba a bit more confidence and a reason to come back. And they do have this quite a long list of holdings. I mean, I've got a printout here of their other holdings in the sector. And there are quite a number of other large ones where they've got double-digit holdings already, and they might come back with another string of resolutions if they are at all encouraged by these results. So I think for the industry, they're very much hoping that these resolutions are not only defeated, but they're defeated soundly. And I think we'll all be watching, won't we, to see exactly what the outcomes are.
Yes, I think you already said you expect this to be only the start, the first skirmish, if you like, in what could be a process that goes on for some time. Just looking at the share price movements this week, it's quite interesting in a way. I should note that the Saba closed-end fund is up by about 2% in the week, which is good. But there have been some interesting divergence. I mean, some of the discounts have waned a little on the 7 trusts, and Henderson Opportunities has performed poorly over the last few days. But a couple of the others have done quite well, including European Smaller Companies Trust, which is another kind of special case where the performance has actually been quite good over a period of time. So can we read anything, Ewan, into what the market seems to be saying? Is it telling us anything about who's going to win these votes?
Well, I think a couple of them had sort of moved to quite unlikely to positions. I think you mentioned Henderson Opportunities was actually on a premium for a period of time, which would be the first time in a very long time. And yeah, as you said, partly driven by the continued, probably quite aggressive purchasing by Saba for some of these trusts. So there's a fair amount of noise from the trust being on reasonably either tight discounts or even premiums in some cases. Perhaps a bit of recognition that there's a risk that you might get further uncertainty regardless of the result of the votes. But yeah, probably reasonably noisy. I wouldn't interpret too much at this stage. But yeah, it will be interesting to see where things settle after the votes, which I think ultimately it would be nice, as Andrew said, to have resounding results from there. But I fear they're probably going to be very close, and it could be interesting. Yeah, I wouldn't be surprised if there's a success from Saba amongst the listing, despite the mobilization we've had of sort of PR and industry voices. But it will be really interesting and a big bellwether from Herald. And Herald does have a reasonable amount of sort of the more institutional wealth managers who will be presumably more voting as small blocks, which might mean it's one of the easier ones to get more of that industry view reflected rather than ones that are explicitly sort of direct retail.
Yeah, I should say I'm not asking you questions about too many of the investment trusts because Deutsche Numis is involved in a couple of those situations. It was restricted on one. But perhaps we could also just quickly mention the Baillie Gifford as a house. I mean, Baillie Gifford came in for the bluntest attack from Bose Weinstein. It's disappointing that we haven't got James Anderson to be there to lock horns with him. That would be quite an interesting argument, since the whole rationale of the BG approach really is long-term patient capital, and no one could have been clearer. That's the way they're going to invest. But they really came in for a punishment there, and Douglas Brody, in particular, Edinburgh Worldwide Investments, the smaller cap global trust, got singled out almost personally by that. And he made the point that Baillie Gifford is having to close funds and maybe laying off people and so on because it has had a bad period of performance. Andrew, I have to ask you this one. Do you think that Baillie Gifford deserves some of this criticism, or are they being caught out in what some have called a perfect storm?
Well, I think Baillie Gifford are quite evangelical in their growth approach. And I think that's very clearly stated, actually. So if you're buying a Baillie Gifford trust, you know that's what you're buying. And of course, this difficult period that they've undoubtedly had comes after a decade or so of fantastic success when we all absolutely love Scottish Mortgage and the other Baillie Gifford trusts that was so successful for so many investors. And they've had a difficult period. Of course they have, but it's a cyclical matter. And actually, growth has been massively out of favour. But I think it's valid to ask that question. Well, should Baillie Gifford have seen that coming, and should they have changed what they do as a result? Or were they right to maintain their offering? And my argument is that I don't want managers vacillating and changing their approach because they think something might be changing in the market. That's my decision as an investor. And I want Baillie Gifford to continue to be a very clearly stated growth house with that mandate. And it's up to me to decide as an investor if I see a cyclical shift coming and I want to sell out. So I think it's very difficult where you are very much focused on one particular style. It's very difficult to overcome a tough period in the markets. And so I feel actually that Baillie Gifford have done the right thing by sticking to that mandate. And also, I feel that this is badly timed from Saba because actually that is now coming back into favour again. And of course, Baillie Gifford US Growth, which is one of these trusts being targeted, had a very good year last year and actually was one of the top share price performers across the entire sector. So it seems to me this would be very much the wrong time to sell out of these Baillie Gifford trusts. And we may well see in another 3 to 6 months that they're actually near the top of the performance tables again. So to my mind, that criticism is not valid. And I want managers to stick to their knitting.
I guess you could say, though, that by having a consistent style across the whole range of what they do, or nearly the whole range of what they do, as a partnership, they've taken on some business risk, shall we say, because there will be periods when that ties out of favour. We know that, and perhaps they're reaping the reward for that at the moment, just as they gained from that an extraordinary period when they could do no wrong, essentially, just a few years ago. Okay, well, we're going to be talking more about Saba next week, I'm sure, and the week after that. We have got a separate edition where I talk to Sue Inglis, who's the Senior Independent Director at Baillie Gifford US Growth, the one you just mentioned. She's got some interesting things to say, not least because her background is in corporate finance, and therefore she has some views on the tactics and the opportunities that Saba has adopted. So there is the world out there which is going on, which other things are happening, and we've got a few minutes just to talk about those. We've got Donald Trump being inaugurated next week. The equity market has been pleased by that, and the bond market has been disappointed by that, or at least concerned about that, I think. Bond yields have risen, and equity markets have done reasonably well, though not so well in the UK. What are your thoughts, Ewan, about this year coming up? A lot of people have pinned their hopes on falling interest rates, particularly as far as many alternative investment trusts are concerned. But that hasn't happened. In fact, the opposite has happened. Do you think that there's going to be relief for the alternative this year against a kind of uncertain macroeconomic backcloth?
Yeah, as always, it's interesting times, isn't it? And the strength of the Trump trade and rally in recent months has been quite incredible. And we've seen the start of this year, that move in bond yields has impacted areas of the investment trust sector, particularly infrastructure. Trusts have continued to be weak at the start of this year to a degree. Private equity discounts widening, debt investment companies also a little bit of weakness on that bond yield movement. So, yeah, it certainly is going to be interesting. And the expectation of rapidly falling interest rates, I've been pretty skeptical of that at the start of last year and probably am again. We have had a shift in environment and we probably learned to live with, well, I wouldn't really call these high interest rates if you look at the very long term, but an environment where there is an interest rate of some degree. The emergency rates of the last decade, I think, is probably not likely to be something that we go back there. But, the big thing will be what we see from the likes of tariffs and potential inflationary impacts on that and the impact that has over time. I think the ramifications of things like this, even when they appear, and the impacts on global trade is going to be a little bit tricky to predict and probably points towards maintaining that bit of diversity and balance and perhaps having your exciting trades in there, but perhaps, we have results from Ruffer this week who are sort of pitching themselves the antithesis of what the market's thinking, which is long equities, wildly optimistic and comfortable with very high valuations. And so probably having a bit of balance in your portfolio for all eventualities is where investors are increasingly looking.
Andrew, what are your thoughts about what Rafa had to say, and how does that square with your own perception or hopes or expectations for this year?
Yeah, it's a really interesting document they put out, actually, a review of 2024. And I would urge you to go and find this and read this, actually, whether you're an optimist or a pessimist, because it's a really interesting document, quite lengthy, actually, and talks in great detail about exactly why Rafa are so pessimistic about equities and why they think there's a lot of risk in the market. They say there's a real disconnect, actually, between the valuation of markets and what is happening in underlying economies. And they're definitely expecting a big snap back in equity prices. They're looking for a big reversal. They say the US in particular is dangerously expensive. So they're very much favouring protection over growth at this point. And I think that's a valid point. I mean, many people do look at the PE ratios and other valuation measures of US equities and feel those are very much at the top end of historical ranges against a quite, let's say, unstable political backdrop. And I think there's a lot of hope pinned on the tech companies and AI to drive those markets higher. And I think there's quite a lot of risk embedded in there. So I have a little bit of sympathy with Rafa, although I'm definitely not that pessimistic. But I was very interested in what's happened in the UK this week economically, because I think it's almost a microcosm of what's likely to come this year. So at the start of the week, there was a great deal of pessimism, mainly based around the bond market and the difficulty of the government funding its debt at a reasonable price. Lots of talk about the government breaking its own fiscal rules and needing to cut spending. And there was a lot of pessimism around. And then in the middle of the week, we had a much better inflation figure than many people expected. And the pound was weak. And those factors both helped equity prices very substantially. So I feel actually there's just a two-way pull in the markets at the moment. And they're always difficult to forecast. Times are always interesting. It's always hard to say what's going to happen next. But I do think we're going to see a bit of volatility ahead.
I'm sure that is correct. We can be sure about that. The interesting thing, I think, about the current situation is that actually it's not impossible that we've had 2 years of 20% gains by the S&P 500, extraordinary against expectations in many cases. And yet there is historical precedent for there being a third year of 20% gains. But of course, the aftermath of those was the late 1990s would be the crash of 2000. So this issue of debt buildup, I think, is critical to that. So I think it's more a question of what investors' risk profile themselves is rather than trying to guess what actually will happen. But I think one thing we can probably say, Ewan, is that the investment trust sector is going to get smaller before it gets bigger. In other words, we're going to get more consolidation, whether Saba related or not. And we're not going to see, at least for a moment or two, I think, a huge wave of new IPOs either. So the investment trust sector is shrinking.
Yeah, it is. 2024 was a record year for corporate activity. If you look at mergers, acquisitions, and particularly funds adopting managed wind downs, there must be sort of mid-teens that go into that category, and a good number that either rolled over into another investment trust, or we've had sort of outright takeovers. And there's a sort of pretty full handful of strategic reviews ongoing with a number of trusts assessing their future. And I think that will continue with an active year for a number of continuation votes. They used to be reasonably probably dull and run-of-the-mill events, but I think with trickier performance history and more vocal, engaged shareholder registers, they're going to be a lot more interesting. Areas like infrastructure have got continuation votes on a number of funds triggered due to wide discounts. So does that trigger more of a focus on capital allocation, returns of capital around those events? Possibly. We've seen private equity investment companies focused on that capital allocation. Where do we spend the marginal pound, and a pickup in buybacks in that area. You've got the likes of Schroeder Global Innovation bringing forward a continuation vote a few months to put that to shareholders. That was previously Woodford Patient Capital. So investors are nursing uncomfortably large losses from IPO there. So I think all the funds that are relatively small can be beautiful, but you also need to attract a broad range of shareholders. So boards need to continue to justify the existence of the fund, and is the mandate relevant? Is it appealing to a wide range of investors? Do they have the right marketing strategy? Are they looking at capital allocation, returning capital through buybacks or tenders, or investing in the next greatest opportunity? But looking at all these factors to make sure that trusts remain relevant in the modern world. And there's no single solution to that, but it's a sort of ever ongoing job for boards, and shareholders are increasingly critical of anything that sort of falls short of the mark.
Yeah, it's certainly going to be an interesting period, an interesting year. I'm afraid we've come to the end of our time. We could go on talking for a long time about this, but there will be further episodes every week of the podcast. And I should say that you can find a link to the rougher review in the weekly email that we send out to subscribers to the Moneymakers Circle. And also, we've drawn on some of the excellent research that Deutsche Numis have done in terms of listing the upcoming votes and so on that we'll be seeing over the course of this year. So I'd like to thank both Andrew McHattie, the editor of the Investment Trust newsletter, and Ewan Lovett-Turner, head of Investment Trust research at Deutsche Numis, for their part in this podcast. And well, next week we'll be talking about the results of the first Saba votes. And as both our guests have been saying, that will be a pointer to what's going to be a very interesting and eventful next few months.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.